Greetings and welcome to the Internal Efficiency Metrics presentation. Supply chain management is one of the most complex and crucial functions within an organization. Key to a company's success is ensuring that the performance of the supply chain supports the goals of the business. This presentation will focus on the internal efficiency metrics that can be used to support the effectiveness of the supply chain within your organization. Internal efficiency metrics can be defined as the ability of a company or a supply chain to use their assets as profitable as possible. These metrics include calculating and understanding inventory value, inventory turns, return on sales, and cash-to-cash cycle time. Inventory value is the value a business has for inventory that has not been sold. Usually this value is calculated at the end of an accounting period, monthly, quarterly, or annually. There are two methods for calculating the value of inventory: the average cost method and the batch method. The average cost method is easier to calculate, but the match method is more accurate. To calculate the average cost, 1. Find the average unit cost, which is the amount that every unit in your inventory costs for consumers to purchase. 2. Find the number of units in your inventory. This is the number of units you have not sold. 3. Multiply the average cost per unit by the number of units in your inventory. For example, if the average cost per unit is $5 and the number of units in your inventory is 1,500, that means your inventory value is $7,500. To calculate using the batch method, 1. Find the unit cost of batch 1. For example, a batch of widgets costs $2 per unit, and there are 100 units per batch. 2. Multiply the unit cost by the quantity of each batch in the inventory to find the inventory value for that batch. Using the above example, that is $2 times 100, or a $200 inventory value. 3. Repeat steps 1 and 2 for each successive batch. Let's say that there are 2 batches in our inventory. Batch 1 is valued above at $200. In batch 2, the widget cost is $4 and a quantity of 150 units. Thus, $4 times 150 is $600 for the inventory value of batch 2. 4. Add up the entire inventory values for each batch. Using the previous examples, it would be $200 plus $600, which would be a total inventory value of $800. One of the most commonly used metrics is inventory turns. This is the number of times that a company's inventory cycle or turns during a given financial reports period. To calculate inventory turns, 1. Calculate the cost of goods sold. One way to do this is to count the number of products sold and multiply the total by the cost to produce each one. Another way is to take the total dollar value of starting inventory, add the cost of production materials and supplies purchased in that period, and subtract the dollar value of the remaining inventory at the end of the period. 2. Calculate the average dollar value of inventory. And 3. Obtain the inventory turn ratio by dividing the cost of goods sold by the average cost of products in the inventory. For example, the total cost of goods sold is $400. Average current dollar value of inventory is $40. $400 divided by $40 equals 10. This means that there are 10 inventory turns during the period. The higher inventory turn number indicates a company is operating efficiently. A low ratio indicates a company has not moved as much inventory and there has not been as much revenue generated. This slow-moving inventory must be maintained, imposing additional costs on the organization. A tool that is used to analyze a company's profitability is a return on sales, ROS, which also indicates the efficiency of the supply chain. Return on sales is sometimes referred to as the margin on sales percentage or the net margin. This metric indicates how efficiently the sales dollar is used, reflecting the ability to manage costs and overhead and operate efficiently. Management can use ROS as an indicator of how the company can withstand negative conditions such as decline in customer demand, falling prices, or rising costs. The larger the ROS figure, the better chances a company has in enduring during these adverse conditions. To calculate ROS, operating profit is divided by total sales and then multiplied by 100. This metric focuses on the number of days payables outstanding and the number of days sales outstanding. Cash-to-cash cycle times measures the times between when a company uses its cash to purchase goods and when payments are received from customers. The speedier the cash-to-cash cycle, the fewer days your cash is unavailable for use. Items that negatively affect a speedy cycle are uncollected receivables and low inventory turns. Slow-moving inventory ties up cash. How long it sits is an indication of how well your supply chain and production flow are in sync with customer demand. To calculate cash to cash, add the days cash is locked up as inventory. Add days cash is obligated to uncollected receivables. Subtract days that cash is free because bills have not been paid. This should equal the cash-to-cash cycle time. To calculate the days cash locked up as inventory, take the average dollar value of inventory during the reporting period divided by the cost of goods sold divided by the number of days in reporting period. To calculate the days of uncollected receivables, take the average dollar value of accounts receivable during the period divided by the sales divided by the number of days in reporting period. To find days of free cash, take the average dollar value of accounts payable during the reporting period divided by cost of goods sold divided by number of days in reporting period. The supply chain is a crucial part of the success of an organization. It is important to know how to measure the efficiency of the supply chain. By doing this, the supply chain professional will know if there are any changes that need to be made in order to make the organization more profitable. Using the key metrics, inventory value, inventory turns, returns on sales, cash-to-cash cycle time to analyze the efficiency of the supply chain is a critical part of the supply chain professional's function. These tasks will assist the organization in growing financially and will show the importance of having a strong supply chain. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.